Welcome back to Risk Management, your virtual guide. Today we're diving deep into the world of risk financing, exploring different strategies to manage those pesky uncertainties that come with life and business. Joining me today are Trishia, a risk management consultant, Descerie Hablos, a financial expert specializing in insurance, Jesreline Paran, an expert on risk retention, and Joshua Pahayahay, a specialist in non-insurance risk transfer methods. Welcome, everyone.
Thank you for having us.
Let's start with the basic. Risk financing is essentially how we handle the financial impact of potential risk. It's about finding the right balance between protecting ourselves from financial losses and maximizing our resources. Risk financing is a techniques of arranging funds to cover losses experienced by an organization. Risk financing is the determination of how an organization will pay for loss events in the most effective and least costly way possible. Risk financing involves the identification of risk, determining how to finance the risk, and monitoring the effectiveness of the financing technique that is chosen. There are two major approaches in risk financing, which is risk retention and risk transfer. And now let's talk about risk retention. Jesreline, you're an expert on this. Can you explain the concept of risk retention?
Hello everyone, thank you for having me today. So, risk retention, an individual or organization's decision to take responsibility for a particular risk it faces, as opposed to transferring the risk over to an insurance company by purchasing insurance. Choosing risk retention as companies' risk management techniques will benefit the organizations since it's less expensive than purchasing insurance until such time and it is needed to pay losses. Two factors of risk retention. We have self-insurance and captive insurance. With that, risk retention is basically the responsibility for potential losses with your own organization. It's like saying, we'll handle this ourselves. Thank you very much for listening. I appreciate the opportunity to share with you today.
Great! Trishia, you're familiar with self-insurance and captive insurers. Can you tell us more about those?
Sure. Self-insurance or internal source of funds is whereby an individual or businesses choose to set aside the needed level of reserve funds to cover its risk. So, it is more often used for predictable, relatively low level of risk, such as minor health expense, property damages, and workplace injuries. And it might be not be suitable for unpredictable risk. While captive insurers is a licensed insurance company established by a non-insurance company or parent to insure the risk of parent company. Just like self-insurance, captive insurers also allows the parent company to retain more control over its risk management and insurance cost. However, because the captive is a licensed insurer, it can also spread through reinsurance. Self-insurance means setting aside funds to cover potential losses yourself. It's like having your own internal insurance plan. And captive insurers are a bit more complex. They're insurance companies, specifically created by a parent company to insure its own risk. Think of it as having your own personal insurance company.
Interesting. So self-insurance and captive insurers are ways to retain risk with within the organization. But what about transferring risk? Descerie, you're our insurance expert. Can you explain the concept of risk transfer through insurance?
It is risk management and control strategy that involves for contractual shifting of a fewer risk from one party to another. One example is the purchase of an insurance policy by which a specified risk of loss and pass from the policyholder to the insurer. Other examples include holder harmless clauses, contractual requirements to provide insurance coverage for another party's benefit and reinsurance. When done effectively, risk transfer allocates risk equitability, placing responsibility for risk of designated parties consistent with their ability to control and insure against the risk liability. Should ideally rest with whichever party have the most control over the sources of potential liability. The risk may transfer through insurance or non-insurance techniques. Insurance is the most common way to risk. You pay premium to an insurance company and they agree to cover certain losses. It's like shifting the burden of risk to someone else.
And what about non-insurance methods of risk transfer? Joshua, you're the specialist in this area. Tell us more.
So for non-insurance, there are two common methods used to reduce risk or eliminate an unwanted potential losses, which is the hedging and hold harmless agreement. Non-insured methods offer alternative ways to manage risk. One common method is hedging, which involves using financial instruments to offset potential losses. Think of it as betting on the opposite outcome to protect yourself. Another method is hold harmless agreement, where one party agrees to take responsibility for another party's actions, shifting the liability.
Let's get into some real-world examples. Descerie, can you give us an example of how insurance works in practice?
Imagine you're a business owner. You could purchase property insurance to cover damage to your building or equipment. This way, if a fire or natural disaster occurs, the insurance company will cover the cost.
And Joshua, can you give us an example of hedging in action?
Let's say you're a farmer who grows corn. You can hedge against price fluctuation by entering into future contract, locking in a price for your corn regardless of market changes. This protects you from losing money if the price of corn drops.
And what about hold harmless agreements?
If you're a contractor working on a project, you might ask the property owner to sign a hold harmless agreement where they agree to take responsibility for any injuries or damages that occur on their property. This shifts the liability to the property owner.
So we've covered a lot of ground today. It's clear that there are many different ways to manage risk, and the best approach will depend on your specific circumstances. Trishia, any final thoughts for our viewers?
Remember, risk management is an ongoing process. It's important to regularly assess your risk, evaluate your options, and adjust your strategies as needed.
Excellent advice! Thank you all for joining me today and sharing your expertise. Until next time, remember to stay informed and manage your risk responsibly.